Well, you gotta be patient, Dragon Knight. The good things come to them, those who wait. How is everyone doing today? If you guys feel lost, let's talk it over in chat. Let's talk it over in let's talk it over in the chat room. There's lots of teachers' assistants. I'm available. I'll be available later this afternoon. Yeah, if anyone is feeling lost, please let us know. Please tell a teacher's assistant privately. Please tell me privately. Do anything, but don't struggle. Let me help you. Let me be your coach. Yes, with regards to the chat, everybody will have their own opinions. What I'm teaching you is fundamentals. I'm teaching you why opinions don't matter. Everybody has their own opinions at the end of the day. Everybody can, disagree about the direction of Bitcoin. Everybody can think that this strategy is a better strategy, that distribution on a percentage is a better strategy than distribution right at the beginning. Everybody can have their own strategy. Everybody can have their own opinion. Opinions are going to differ wildly. What I'm teaching you is how to take those opinions and form your own. Backtest your strategy. Take their opinion and apply it in the past, in the future. See if it works right here on paper. If you're a hands-on learner, get out your piece of paper and your pencil. Get out your trading view. Start drawing lines. Start cost averaging down in a spreadsheet. There's no reason for you to not be hands-on with this. Don't just watch videos. Get out your trading view. Get out your spreadsheet. Start making plans for profitability. Don't just sit on the sidelines. The more you put into this, the more you're going to get out of this. This isn't about just watching videos and waiting for the next lesson. This is about taking what you've learned so far and applying it to making a plan. Make that plan. Don't wait for me. I'm not going to make the plan for you at the end of Dojo. Absolutely. Hands-on paper trading on TradingView. You betcha. Right here. I bought right here, and then I bought again right here, and then I bought again right here. What is the cost of my Bitcoins? If I had to buy again right here, what would the cost of my Bitcoins be? You want to be hands-on? Get your calculator out. Get your spreadsheets out. Start making a plan using what I have taught you. Hands on, man. You bet. You know, Crypto Santori, I can't take your hands and put them on your mouse and make you go to TradingView and make you dollar cost average down your position on paper. I can't. Yeah, absolutely. Share your plans in the boiler room. Need help with a spreadsheet? Ask a TA. It's not about their opinion, it's about your opinion. What do you think works best? Find out. Go back in the market, get hands-on with this market. Get hands-on with a different market. Heck with Bitcoin. Who cares about Bitcoin? Go look at Quantum. Go look at Komodo. Go schedule your downside on a different market. Don't use my work. Get hands-on with it. The sooner you do, the sooner you're going to start actually doing the work. That's when you're going to start figuring it out. If you are not painting the fence and sanding the floor, you're not building muscle memory. You're just waiting for me to do it for you. That's never going to work. I like Neo too. Okay then, let's get started. Hello everyone, I am Sensei Kevlar. Welcome to the Way of the Trader. Previously in Dojo, we've learned how we can use support and resistance lines to schedule our downside opportunity generation. I've invited you to get real hands-on with creating your plans. Go in here to these markets and create your opportunities on paper. Figure out what these markets will give you in terms of your opportunity generation, and then do it moving forward. Here we are at the beginning of the month. You could have been paper trading the whole of this month right here. Want to find out where this market will go in the future? We'll take one position on paper and schedule your downside and see if you could have made money that way. Get hands-on with it. Because next thing we're going to do is we're going to figure out how to take these strategies and maximize them. What we want to do is we want to ensure that we're only buying at levels that we think it can come up again if we're multiplying on the way down. We want to only make sure that we're selling at places where we think the market really is going to stop and turn around again. We want to make sure that we are maximizing these opportunities and building strategies that keep us profitable no matter what, while making sure that we're also taking advantage of every opportunity within these markets. So that starts with backtesting. That starts with going back here into the market and saying, well, if I had sold here, I could have made so much money, but what if I had used a different strategy instead, a different distribution strategy instead? Would I have made more money historically? Would I have made more money if I had used that same distribution strategy here? Turns out I might not have. I would have made more money in this condition and less money in this condition. Go back and find out what the answer is. Build your strategy. Build your plan. Exercise those muscles, that muscle being the one above your shoulders. Build that discipline to staying discipline to a plan that you have built, because nobody else is going to build your plan for you in order to make you profitable. You're going to have to do it. So as we are looking at these charts, we can see that there are definitely some places that would have been better than others to do our selling at. As we're looking at these charts, we can see that there's definitely some places that would have been better than others to do our buying at. So can we make a plan to incorporate this idea of keeping us out of the market while the market is still in motion? Well, what we would need to do is we would need to incorporate further intelligence into our plan. So what we would do is, instead of just saying, I'm going to plan to buy at every level on down here, instead what I'm going to do is I'm going to say, I'm going to plan to buy at every level on down here, but only if I have additional indicators which tell me that here would be a good time to buy. Here would be a good time to plan to buy. Well, what indicators might we use? Well, one indicator we might use is volume. If you look at this volume right here, we can see that every time that the market is not supported at a particular price level, the volume gets really low comparatively. Right here, we're coming up against the resistance line, but volume is not coming up to spike like it is here or here. Meanwhile, when we're down here against this resistance line, suddenly volume is becoming spiky, and now it's definitely a better time to buy. So instead of just blindly buying at every level on down, as we have scheduled for our entire downside, we could schedule our entire downside and then be opportunistic about our opportunities. We could say, oh look, right here, this is not getting this volume spike that we're looking for. We're looking for something above, this line right here, and we're not seeing it. But on this line, suddenly, we are seeing that volume spike. So we could skip this line on a lack of volume and go directly to buying on this line, and again on this line, on the volume spike. What this would do is this would save us some heartache. This would save us having to buy in here and give us a better price down here. Why would we want to buy something here if we're just going to get a better price for it here and here? We could have skipped this one. Having a plan is about maximizing your opportunities on the downside, but it's also about maximizing your opportunities when that downside isn't going to give you an upside. The same thing on the upside. Right here, when we're moving upward, we're doing so with a lot of volume. But right here, the volume has decreased. We're doing less volume. Therefore, this might be a better place to do our selling at than this place right here where we're moving up on a lot of volume. You see how volume has decreased? Let's come in here and draw that trend line. Look at that nice little trend line right there. What we're saying is that interest in the market, people who are wanting to get into the market at this price, is decreasing over time according to the buys and sells that are happening in the market. So in this way, we can take advantage of this and say, maybe this is a good time to be doing our selling. Maybe right here isn't the best place to be doing our selling because we're still moving up on lots of volatility. We could come back down and wait and be more profitable by coming up to here. In this way, we can say, make a plan to maximize our opportunities by incorporating additional indicators into our strategy. We can maximize the strategy that we already set out for ourselves. It starts with one position. We take one position and then we schedule our downside against that one position. If we're starting here, we use one position and then we schedule all of this downside. If we're starting here, we use one position and we schedule all of this downside. Depending upon how far down we need to go, if we're starting up here, we might need to use a 2x multiplier in order to arrive at the right place, or we might need to schedule less lines. If we're down here, we can use one position and schedule a 4x multiplier, which is a much heavier opportunity generator for us. But here, this is a small opportunity generator for us. We need to use one position and then schedule the whole downside to come all the way down to here, and then maximize those opportunities through further buying and scheduling potential. Yes, I'm sorry if I didn't answer that before. Volume is the amount of buying or selling. Earlier I was talking about this is the price. This is what price people were buying things out. This is how much buying or selling they were doing. That's volume across the bottom there. So what we're trying to do is we're trying to build additional indicators in order to measure volume or trend. Here's another example of a trend that we can measure. This trend right here, well, it was respected over and over. And look at this right here. This trend right here was respected over and over and over again. So long as we're seeing this trend get respected, if it starts out that we draw this trend right here, and we just draw this trend into the future, pull it out into there, touch this tip to this tip, and then extend it out into the future. If we're seeing this trend get respected over and over again, why would we sell? Seems to me the trend is telling us that we can still go up. Look at what happens the minute that we break through the trend. Well, look at what happens historically when a trend like that gets broken. Or when a trend like that gets broken. Or when a trend like that gets broken, right? Let's look back in the charts here. Let's look back at historically what happens when a trend like that gets broken. Historically, most of the time, we come down. The large majority of the time, whenever a trend like that gets broken, we come down. Build your strategy. Make sure that your strategy works in the market and tests correctly in the market and ensures that you are staying maximally profitable. Why sell if your trend line tells you that you're still going to go up? Here's the place to sell right here, where the trend line gets broken. Okay? Here's the place to sell right here, where the trend line gets broken. And here is the place to sell right here, when the trend line gets broken. Incorporate the idea of increasing the number of indicators into your buying and selling strategy. Doing so and testing it in the past will yield different results. Get hands-on with creating your strategy, incorporating all of the different indicators that you can find into that strategy, and maximizing your potential in these markets. But always plan for your maximum downside. All that we're doing is we're saying, well, I think that we can get more profit if I wait. Well, what if I'm wrong? What if I think that this trend line is going to get respected right here, and then I wake up in the morning and it's done one of these? That's an interesting drawing tool. I didn't mean to select that one. What if I wake up in the morning and it's done one of these? Well, nothing. You're just back where you started. Number one, you could have taken a portion of your profits here and then taken this ride back down and bought it all back. And if you had tested for that, you would have known that would have been an opportunity for you that you could have created for yourself, but only if you had gone back into the market and tested for that. Only if you had set up a plan that would have you doing that, have you taking a portion of your profits right here. This trend line can help you, but it can't predict the future perfectly. You still have to have a plan in place for when it does this instead. The plan never changes. The plan always looks like you're allocating your downside potential. Look, if you crossed your profitability line and you were waiting and you saw this and then it came down here, well, you crossed your profitability line down here, you could still take profits right here off this broken trend line right here. You can still take profits right here off this broken trend line right here. Take a little bit more profits, wait for it to come back down. Any way that you work your plan, any way that you develop your strategy, as long as it has you being profitable, it's valid. That's what matters. As long as you are scheduling your entire downside, well, nobody can tell you what your plan should be because nobody knows what your portfolio is. If you do not allocate a tiny percentage of your portfolio for the bottom of the market here, you're not going to be in good shape for the rest of your opportunities. If you don't start with one tiny position at the top here, you can't schedule your entire downside for 1% allocation at the bottom. If you start with a large position because you think that you're boss and you're going to go up, I'm not sure how far you can go down. I don't care how big your portfolio is. Do the math. Find out just how fast 4xing that big position on every single trend line here, on every single support and resistance line here, will make you. It'll make you fat at the bottom, and then you'll be unhappy when it continues to sink away from you. Question being asked is, does the trend line get broken the most if volume is small? The answer is, find out. Go back in the market, draw the trend line, and look at volume. If it's true, it's a good indicator. If it's not true, it's a less good indicator. The more that you find it in the past, the more that you find it in the future, the better indicator it is to let you know where we're going. Incorporate those indicators into your plan. So what we've done here is we've looked at the trend and we've drawn it manually. Well, what this trend consists of is it actually consists of a series of higher closes than opens. The more trend lines that you have in order to tell you what the opportunity is here, the more information that you can glean, the better your plan can become in order to keep you in the right market motions and maximizing your opportunities while still keeping the plan exactly the same all the way to the bottom. What you can do is you can use something like an indicator. And what an indicator does is the indicator will crunch the numbers for you. An example of an indicator that crunches the volume is the CM Williams VIX Fix finds market bottoms. So what I'm going to do is I'm going to come up to indicators here, and I'm going to type in CM Williams and click on the find market bottoms. What this indicator does is this analyzes the volume trends for us. It comes in here and it says, oh, look, volume is spiking and the trend is down. If that's the case, if we get a bunch of closes that are twice as big as the opens, then it's going to color these volume bars green. Now, the point of this is to get hands-on and find out if this really does work. Was this a market bottom? Was the indicator green and spiky? Was this a market bottom? Was the indicator green and spiky? Market bottom, indicator green and spiky. Market bottom, indicator green and spiky. Market bottom, indicator green and spiky. The more spiky and high the indicator went, the higher the bounce we got. Could we make a plan that incorporates this into our strategy while still planning for the entire downside of the market? Absolutely we can. By incorporating additional information, we might have known not to buy at this level. Look at what happened here. Is if the Williams indicator doesn't say green, we don't buy. Here it said green, and we bought, and here it said green, and we bought, and here it said green, and we bought, but here it kept us out of the market. It kept us out of the market for all of this motion right here. How much did it keep us out of the market right there? A good 10%. It saved us 10% just by incorporating over 3 days, just by incorporating more information here. We would have bought here. We would have known to sell here. Look at this. Look at the drop in volume. Look at how low volume got here. By incorporating this volume indicator, we can tell additional information about where the market might go. We can plan better. We can say, oh, we might want to do more selling here than we had previously thought we were going to do when we got back to this line. We can make a plan that says, if we return to this line, then we do our selling. But if we come here, if we come, above the resistance line, and volume is low, volume is dropping rapidly, we go ahead and sell because we might not make it up. Here's the time when we thought, this volume indicator would have kept us from buying. This would have had us selling, kept us from buying. Now we know it's time to sell. Now look at what happened here. We got a small itty bitty green spike. Is this anything like this green spike right here? No. I would say that this indicator is much more weak than this indicator. And so we can further evolve the plan. We don't consider this a market bottom unless it goes above, unless it hits, let's say, 20 over here. 20 seems to be the times when it really did signal a bottom. Here it went above 20, and it really did signal a bottom. Here it went above 20, and it really did signal a bottom. What if we only did our buying when the indicator went above 20 and we touched a bottom? Touch our toes, heads up. Incorporate that into your strategy. Let's make more plans, right? The more plans that we can make to make ourselves profitable, the longer that we will stay out of these markets when they're coming down on us. Right here, we didn't quite get to 20. We could have not bought on this line right here. Previously, we were buying here. We were not buying here, but then we were buying here. Now, because we made a new plan to not buy unless we reach 20, we're not buying here and we're not buying here. And now we're buying here and here because it did go above 20 here and here. We'll look at how much more profit potential we could have created for ourselves simply by modifying our plan. Got to own the plan. Plan the trade. Trade the plan. Love that CM Williams. Let's look at another indicator right now. Volume is fairly easy to understand because it's just a number. We traded so many Bitcoins in this time frame, and so many Bitcoins in this time frame, and so many Bitcoins in this time frame. And this number was less than this number. This is a big number, this is a small number. Easy to see, easy to visualize. Trends are a little bit more tricky, but once you get the hang of spotting them, once you get the hang of coming in here with your drawing tools and getting real hands-on with your drawing tools, figuring them out, they start to pop out at you. You start to be able to get to the point where you can see the trend get broken automatically. Look at here. Trend line broken, CM Williams, touch resistance. Support, rather. Touch support. 1, 2, 3 indicators. And we make money. Trend line broken. Bring it on down. 1, 2, 3. And we make money. CM Williams. Resistance and support. Trend line broken. 1, 2, 3. Okay. What's a 4? Can we add a 4 and a 5 and a 6 and a 10? Let's look at some more indicators. I can't tell you what indicators are going to work best. What I can tell you is that you should look at all the indicators. Let's look at how some more indicators work. If we want to look at how to compute the trend with an indicator, what we would need to do is we would need to look at the price action. We need to look at the number of highs, the number of opens that came, or the number of closes that came up versus the number of closes that came down. So what we're doing here is we're looking at this and we're doing a 6-hour window, and what we could do is we could take the close of every candle. This close was 3,824. This close was 3,675. This close was 3,643. This close was 3,687. What I've done is I've formed a series of numbers using the close of my candles. Da-dun, 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 da-dun. If I were to take that series of numbers and put them into a spreadsheet, here's that spreadsheet right here. Let's pretend that we're back in a market that's $44. And then the next close is $44.09, $44.15, $43.61. You can see the market's going up here. The market's going down here. Over time, the market's moving around. All I've done is I've taken the values from my candles out of my candles, and I put them into a time series. Now what I want to do is I want to measure the change. Okay? So from this one to this one, from my first close candle to my next close candle, did I go up or did I go down? Well, I went from 34 to 09, from 44.34 to 44.09, which is a difference of 25 cents. So we count that as a loss of 25 cents. From 44.09 we went to 44.15, which is a gain of which is a change of positive 6 cents. So we count that as a gain of positive 6 cents. And in this way, we look at the next change from the previous change, compute the change, and if it was positive, we create our positive gain series. And then if it was negative, we create our negative gain series. Okay? So the first price, this is the second price, this is the first change because of the first time we had a difference to measure. And what we're going to do is we're going to take those absolute values and we're going to put them into an absolute time series here. Then what we're going to do is we're going to take what's called a moving average window. The idea behind a moving average window is we want to take some time frame. We want to take the time frame of, let's say, 14 periods, which on a one-day chart is a 2-week period. We take the time frame of 1 day changes and we average them together. In exactly the same way that we take this time frame and average it together, this 14-day time frame, we put this in as the next value for our average change. Okay? Then for the next value, we're going to take the same idea with a 14-day moving window, which will drop one item off the previous average and incorporate a new item in the new average, and this will give us our new average change. For the next item, we're going to do the same, and that will compute our average across that, average of this, etc., etc., etc. Okay? We're also going to do exactly the same thing for our we're going to do this for our gain, and we're going to do this for our loss, and we're going to compute the average of our gains against the average of our losses over a moving window. So we can see that in this time frame right here, at this time period right here, the average of our gains over the last 14 periods is about 24 cents. We've gained on average 24 cents over the last 14 periods. You can see that as we move on, that average gain continues. We have 22.21 because what we're doing is we're incorporating this time frame and then making our average. Then we're incorporating this time frame, making our average. Then we're incorporating this time frame, making our average, all the way on down. Same thing with the loss. Taking the loss, taking the time frame, computing the average of this time frame, adding them up, dividing by the number of periods. Okay? You can see here it's the sum of F4 to F17, F4 to F17 divided by 14, which is the number of periods. Now, what we're going to do is we're going to compute the relative strength of these two. We're going to compute the average gain against our average loss simply by computing by dividing the average gain by the average loss. Okay, so if we take this and we divide it by this, take the average gain divided by the average loss, we come out with 2.39 for our relative strength. What this is measuring is the difference between our average gain and our average loss. Okay. Finally, we do a graphing trick, which allows us to take a value and center it on a 50 line, and then if it goes above that 50 line, that means that we have seen a positive change in the past. And if it goes below that 50 line, it means we have seen a negative change in the past. That formula is right here. What we're going to do is we're going to take our relative strength, which is our average gain divided by our average loss. Average gain divided by the average loss gives us our relative strength. Then we're going to add 1, take that, take 100 and divide it by that, and then take 100 and subtract it from that. And that will give us a number that is centered around 50, that will move between 100 and 0, centered around 50. As a result, if this number drops to 0, in order to represent an average gain and an average loss that is identical, no average motion in the market, this number will go to 50, and we will see that the market has become neutral. The trend of the market has become neutral because the average gain is equal to the average loss. If the average gain is equal to the average loss, then the relative strength will be 0, or 1 rather. It'll be 1. That's the trick. It'll be 1 because the divider will divide equally into each other. And then that will center on 50 per this formula right here. If it goes below 1, here we see it go below 1, and you can see it go below 50 on the RSI. Here's your relative strength. Here's your RSI, your relative strength index, centered around the 50 line. So instead of seeing it go between 2 and 0, we're seeing it go between 50 and 100. So you wouldn't actually do this. You wouldn't actually come in here and make your spreadsheets. What you need to understand is you're taking your close numbers and you're computing your change difference. And then you're computing the average of that change difference over a moving window, giving you this number here. You're then taking that change difference, dividing it to see, did you get more upward motion than downward motion, or more downward motion than upward motion, to give you your relative strength, and then making a chart which in upward motion will show a positive trend line, and in downward motion will show a negative trend line. So let's see this applied. The relative strength index. I'm going to come up here, I'm going to click on indicators, I'm going to type in relative strength index, I'm going to add it to my chart. Let's get rid of the Williams for just 1 second. We'll bring him back again. I promise. I know how much you like the Williams. And let's look at what happened here. Here is our measurement between 100 and 0. And what we've done is we've taken the closes, we've put them into our spreadsheet, we've extracted the change from one value to the next, we've extracted the average gain and loss over a time frame. We've divided that by each other to find out if we got more gains than losses or more losses than gains. And then we've centered it around our 50 line. Here's our trend right here. Previously, you had to go in here and say, did this trend get broken? See it with your eyes. Well, here's your chance to see if the trend gets broken. Every time that we go above the 70 line, and then we make a quick return to the 50 line, you can see what happens. What this is telling us, let's go out to a 1-day chart. Look at this. What this is telling us is the relative trend. Here we can say that we had a lot of upward trend. Here the market went sideways and it went neutral. Here it went down. Here this was an upward trend relative to the previous trend. Here this was a downward trend relative to the previous trend. Right now we have made a return to the norm. Right here, we're hovering around our 50 line. We just touched 50, bounced right off of it, got a little return. The question you need to be asking yourself is, historically, when we had a lot of spikiness, did we eventually see a return down here? Did we eventually see this? How many times did we come down, touch the 50 line, go up again, followed by the return down to 20? Touch the 70 line, then followed by the return to the 20. If you had been working this, if you had said, okay, well 70 doesn't tell me enough, but 80 does, what if I had only done my selling at the 80 line when things went over 80? Look at how when I put my mouse on the 80 line, suddenly the RSI tells me when I should be doing my selling. And now I've incorporated a new indicator. Let's bring back that CM Williams. Okay. Trend 1, support and resistance. 2, trend line broken. 3, Williams indicator bottom. 4, RSI below 20. The more indicators that we can use to incorporate into our strategy, the more that we can optimize our strategy, both in testing and in reality. But having indicators alone will not schedule our downside for us. We always need to be prepared for this moment right here. If you're not scheduled for this, no indicator will help you. Indicators are used to ensure that your plan for profitability is really giving you the most profitability that your market can possibly give you. In order to find out if that's true, you got to go back and make a plan. You got to incorporate your knowledge of the market into the plan, and you got to study indicators. I can't tell you which indicators are going to be best. I can't even tell you what indicators I might use in any particular market. It varies from market situation to market situation. Let's look at one more type of indicator, which is the predictive indicator. I'm going to get rid of some of these lines right now. And I'm going to see if I can't use an indicator to tell me where the market might go and how to better optimize my plan. Let's say that I'm here in the market and I don't know where Bitcoin is going to go. But here's what I do know. Number 1, support. Number 2, Green-Williams indicator. Number 3, RSI below 20 on the one-day chart. Number 4, trend line broken. Well, what a fantastic opportunity to buy. Can I come in here and find more indicators to use? Absolutely. Anything that tells you what it is that you want to know, come in here, find out what these indicators do, find out how they're computed, study them, incorporate them into your studies, incorporate them into your technical analysis, incorporate them into your understanding of what the market is telling you. Because look, if I made a plan and I just worked off of, this right here, and I said, oh look, the average true range is up again, my chop is hitting my 40 line once again, except now that my chop is hitting my 40 line at the same time my RSI is hitting my 20 line at the same time that my Williams indicator. Well, if I had waited, if I had had a plan that said don't buy unless your RSI was below 25, was hitting the 30 line right there, there's the 30 line right there. If I had a plan that said that and I was being disciplined in my plan, great. I could have scheduled this upside right here for myself against this side, this downside right here, this whole downside right here, all the way down and all the way down to 0. Come in here and find all of my support and resistance, okay? But then from here, we're in a new market high. We have basically no business intel. We have no market intelligence about where we can go next. There's no way that you can know what your scheduled upside potential is beyond this line right here. Or can we? Well, let me get rid of these things again. Markets always move inside of standard deviations. Talking about the bell curve. One standard deviation is 33%, two standard deviations is 66, approximately 61.8%. This follows the golden mean ratio, which is expressed in the Fibonacci sequence, 1, 1, 2, 3, 5, in which every number is followed by the addition of its previous number in the sequence. We see these types of sequences in these markets all the time. What I'm going to do is I'm going to come up here and I'm going to touch the bottom of this market to the top of this market, and then I'm going to find where the Fibonacci retracement happens. The Fibonacci retracement is, this is 50% of the motion right here. This is, if this is 0% of the motion and this is 100% of the motion that I'm measuring in the market, then this is my 50% line, my 0.5 line, right here at 1,592. Now, if I wanted to know where I could come down to, well, look at what happened here. These represent the golden mean ratios, the 0.618 and the 0.382 on either side, and then this is half again of the 50% line, the 0.786. This is double the golden. This is double the mean. The 236 is double the ratio right here, and again this is our 100% mark. This is 0%. This is 100%. What we're measuring is we're measuring the standard deviation of this motion right here. If we are moving within a standard deviation of our market, then we should be able to find these lines within our market and see that the market moves against these standard deviation lines. Well, does it? If we're just measuring this motion right here and we're saying that the market will move within a set of standard deviations of this motion, look at this line right here. Look at this line right here. Look at this line right here. It absolutely did. It absolutely moved within standard deviations of this motion right here. It came up to within a standard deviation of this motion right here, or another way of thinking about this is this motion right here is 3 times the standard deviation of this motion right here. All we did was we took our range of motion that we were doing in the market and we multiplied it by 3. Here was a 2x multiplier. Here was a 3x multiplier. Could we see a 4x multiplier on that? Yes, but we would need to use a standard deviation projection instead. That was a standard deviation retracement. This is a standard deviation extension using a Fibonacci extension. Again, what we're going to do is we're going to measure this motion down to this motion, and we're just going to extend it on out into the future. Okay? Well, what are we saying here? We're saying that if this market were to make a standard deviation of this motion right here, well, that starting from this line right here, where we came down to, where we are in the market right now, this would be 100% of the motion again, right here. The 5,100 line. Yeah, the 5,000 line. Right there. We say if this is how much motion we're going to measure, and then we wanted to measure this motion from here to here, off of this line again, right here, where we came and turned around, that would take us to 5,000. Well, could we predict using, if we were right here in the market and we just said, well, what's the standard deviation of this motion right here projected into the future? It would be 5,000. Where could we schedule our opportunity for our distribution for? We would do it here on this line. Obviously, that's our current top. We would do it here. We would do it here. 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 And finally, here. Look at how I have projected my upside potential, which I am potentially unaware of. This is a new market high, and I've never been this high in the market before, and I can't possibly know where the market is going to turn around on me. All I've done is I've measured this motion down to this motion right here, and then I projected that motion from here up to 100%. And then I've measured the standard deviations of that motion, and I projected them into the future. Let's see if this would have told us where I could go with my distribution. I'm not saying that these lines are always relevant in the market, but if you go back and you test them, and then you find in the future that the market is turning around right on the line that you predicted in the past, in the future, and it's turning around right on the line that you predicted in the past, in the future, you might want to incorporate this type of planning into your plan and then trade that plan. All I did was I projected the motion from here to here, coming off of this line, off of this bounce right here, moving up again, and it told me exactly where the market was going to turn around in the future. These are lagging indicators. These are telling you what has happened in the past, because we're looking at a moving average window over the past, and we're trying to measure that trend from the past and how it's changing relative to the present. This is a predictive indicator. This can tell you the past and where we've been, and this can tell you the future and where we're going. You want to know where Bitcoin's headed to? How about 6,500, anyone? I'm not saying it's going to happen. What I'm saying is that you need to schedule your downside potential through all of this right here, and test the strategy that's going to make you the most profitable. Get hands-on with your strategy creation, hands-on with your backtesting, hands-on with your indicators, and find out the strategy that's going to give you all of your money in this market. Do it going back, and then do it going forward on paper, and find out how to make yourself profitable. Plan the trade, and trade the plan. And that is the way of the trader. Thank you very much, everyone.